3, 3. 1, 2, great. Okay, awesome. 2, 3, 2, 2, great. 1, perfect. Okay, 3, yep. Great, I think you're in the right place. Okay, hope you can turn all of this around and make it awesome for you guys and make this trading positive going forward. Okay, that's what we want to do. Okay, perfect. Thanks guys for the feedback there. I appreciate it. All right, so here is me with my wife in Puerto Rico. I have 5 kids there in the middle and an MBA program on the right-hand side a long time ago. So just a regular guy trying to make a living at trading and loving my life, actually, in the meantime. All right, so let's talk about mindset here because this is really important. Imagine what it would feel like, okay, if most of your trades were winners month after month, and it would be confirmed by watching the size of your trade from your account grow at the same time, all right? Also, becoming the trader that no longer takes large losses but consistently trades according to a plan that is profitable over time, allowing you to grow your account month over month, okay? And I'll share with you guys the performance of this, and I'm telling you, you can do it too, all right? If I can do it, you can do it, all right? So hang in there. We're gonna make it good for you guys, okay? So let's first talk about an SPX credit spread because these are the trades that I use in order to gain income, okay, month over month, right? It's a SPX credit spread, all right? So a credit spread is a combination of 2 puts and 2 calls where the put or call that is sold is more expensive than the put or call that is bought. So basically, when you put on this trade, you're selling it and you're getting a credit for selling that trade, okay? So you sell it and then you buy it back at the end, right? And that's how credit spreads work. So you're selling the 40-50 in this example and buying the 40-40 put, okay? And that's called a vertical spread. And this gives you what is credit, what is a credit, and it's a high probability trade. It's basically considered a high probability trade, all right? So all that's good. However, there's another side to this too, okay? So let's talk about risk reward. And risk reward on a credit spread is probably one of the worst in the trading realm, okay? So what you're doing is you're collecting 50 cents in this case, right? So it's 50 times 100, which is $50. And then your risk reward is basically you have to put out $1,000 minus the $50, right, that you bring in. So you're risking $950 basically to get a $50 reward for that, okay? However, again, this is a high probability trades and 80 to 90% of your trading is going to be profitable, right? It's the other side, the risk management side, that you need to worry about and how to manage that. All right. Okay. So let's go on and talk about one of the major profitability factors for why this trade is a high probability trade. Okay, this is the decay of options, or actually this is a call option, and the journey that it takes for its life. Okay, so from 68 days to 33 days, the rate of decay is 34%. From 33 days to 5 days, the rate of decay is 57%, and from 5 days to expiration is 100%. Now you can imagine it's 5 days to expiration. If we go down to 0, right, that decay rapidly goes down in value, all right? And so it's the fastest way to gain income in a decaying scenario for credit spreads. Okay, all right, so let's talk about the other profitability factors. So we talked about decay, and that's theta. Implied volatility. So volatility, you want to enter a trade when the volatility is high and exit the trade when the volatility is low. Now I place a trade in the first 5 minutes of the trading day around 9:30 to 9:35. The reason I do that is because generally, most of the time, that the volatility at that time is the highest during the trading session. Okay. Now, during, after the trading session, maybe towards the end, there are times that there's volatility that increases at that time, but most of the time, the volatility is concentrated at the very first 5 minutes to 10 minutes of the trading day, and that's when I put on the trade. Okay, because I want to take advantage of that volatility. Theta, we just talked about, that's one of the Greeks, and it measures the rate of decline of the value of the option during that passage of time. Okay, and then profitability number 3 is the market direction. Okay, so if you can get the market direction right every time on these trades, then you're going to be profitable. So a market trending away from your position will cause the premium to price to drop. And if you enter this trade at the market, when it moves against you or in the direction of the credit spread, you will see the premium price increase significantly. But as long as it stays within that range that you have, it will remain profitable. So you can have a losing trade all through the session, but have make it profitable as long as it stays in that range. Okay. All right. So let's talk about some of the routines that I go through. And then risk management, and then we'll talk about the routine. So number 1 is always trade with a plan. Okay. Number 2, determine max loss and risk reward before entering trade. Now we talked about that already. Okay. And there's different scenarios for different types of trade, but the important thing is that you need to know and be educated on how to manage these trades so that you don't get in trouble. Okay. Trade no more than 20% capital on these trades. Okay, so don't go above. Always keep 80% cash in your account to trade these positions. And I understand and realize that a lot of you may not be able to, but that's the best way to trade these trades and be profitable. Okay, do not allow more than 2% loss based on trading capital at risk. And that way it keeps you solvent. And for highly trending markets, position trades that you want to follow the trend. All right. Size your trades to ensure emotions are not part of the decision-making process. I always say trade small and trade often. Okay, so let's go through the pre and post-market routine. Review the areas of support and resistance. That's really important as a trader, where those are. Went ahead here. Review the U.S. dollar for price action. U.S. dollar, is if the dollar's moving higher, it puts pressure on the SPX just because of the the way that the SPX does its pricing. Okay, when they sell goods to outside companies. Review the 10-year Treasury. If the Treasury bonds are moving higher, basically there's competition for cash, and that also puts pressure on your positions. All right. Review ES futures because those trade basically 24/7, other than Saturday and Sunday, and that gives you a good trend of where the market's going. Review the VIX level. VIX is the volatility index for the SPX, and so it's good to know where that is when you're trading. And then determine your credit spread positions when you place them, so that you're ready to place them right when you enter the market. Okay, and that's really specifically mostly for 0DTE. Okay. All right, post-market routine, determine if rules were broken and why. Determine if risk was within acceptable levels. Determine if your losses were within acceptable ranges. Determine if tweaks or adjustments are needed for your trade plan. And you always want to be on top of that as well, okay? Update your trade journal with your findings, and it's good to have a trade journal just to understand how you do and what you're doing, and maybe understanding what mistakes you make and what you're good at as well. All right. Before we get into the nuts and bolts of the actual trade itself, I'm going to talk about pattern day trades. All right, and this is really, really important if you're not aware, and I'm sure most people are aware of this, but I want to cover this so that you don't get caught. Okay, so what is it? It's the buying and selling and buying the same security in the same day, and it initiates days trade from 3 trades to 5 trades. Okay, so you can't trade more than 4 trades, actually more than 3 trades within a 5-day consecutive period. All right, so you want to keep that in mind. All right, and not trade, not day trade more than that, or else your broker will restrict you to basically just selling funds, selling trades out, and not buying and not initiating trades. What can happen if your account value is below 25,000? Your account can be restricted to only selling current holdings. All right, so make sure you understand that. Now, we have a way of avoiding that. Okay, and I'm going to share that information with you for how you can do a very, very similar trade that doesn't have PDT restrictions, and you can do this all day long without a $25,000 account. Okay, all right, and we'll talk about that in just a few minutes. All right, so how to avoid pattern day trade is limit trades to one trade, 3 days a week. Manage trades from multiple accounts. Trade wide iron condors to allow them and allow them to expire. Trade ES future spreads since those are not subject to PDT. Okay, and options on futures is what we're going to talk about too in this session, so that you're aware that you have an alternative to SPX credit spreads. All right, perfect. Okie dokie. So let's go through the specific strategy of managing SPX 0 DTE trades. Okay, we're going to talk about out of the money, in the money, and same strikes, lower strikes, widened spreads. So we're going to talk about all of that and how you can maneuver using different tactics so that you don't get caught in a big loss. Okay, all right. So I'm going to start with the criteria for this, and this is basically your trade plan, okay, or the trade plan that I use. Enter within the first 1 to 10 minutes of the market opening using a 5 to 30 wide spread. All right, so there are different ways to trade these. I trade 10 wide, but there are traders that trade 5 wide to 30 wide and even greater. It's basically up to you, okay, to do that. Okay. Wider spreads provide a greater distance to the market. It causes less risk, and I'm going to show you a graph of that, specifically so that you're aware of what the difference is in trading 5 wide, 10 wide, 15 wide, and 20 wide. Okay. Okay. So premium should be between 45 to 90. That's where, to me, is a sweet spot. It's usually between a 5 to 7 delta on the with that Greek, and it's worked out for me pretty well. All right. I know a lot of traders also widen their positions and still use 50 cents to 70 cents, and it's basically to reduce risk. Okay. Okay. So closing the short strike, to take profit, you can do it by just closing it for 10 cents, or you can actually close the short strike for 5 cents, and that will still be a day trade, but you can collect, basically more profit on this. Okay, a lot of people, we let them expire in our group. I try really hard to allow them to expire, and that way you don't have to worry about day trades. Okay. All right. Expiration is just the other way to let it go away, that position. All right, when a trade is threatened, now the most common way that people use this is to use 2x or 3x, the short strike, as a stop loss, right? Now, I use it mostly for bear spreads, just because bear spreads are, can get much closer to the market than bull spreads, and that's basically what I've been doing. And I typically roll the bull spreads so that that way we can roll it out, and it's a much easier process to do rather than bear spreads. Okay, bear spreads you can get caught, and I'm actually in a roll right now where I've done it. I think we're in our 12th roll, for a bear spread, and that's just crazy, right? But we're getting ahead of it finally. So, but I can tell you that I'm not going to do that again. I'm not gonna be rolling bear spreads anymore. Okay, so you want to roll near or at the money 1 to 2 days out if you're going to roll the trade. I would say that you want to roll it before you get in the money or at the money. You want to get it basically at least 5 to 10 points away from the market in order to get a decent roll. And again, we'll go through that in great detail. All right. Rolling in the money, you can widen the spread, but still it is tough to manage after that. All right. So do it ahead of time, and your life will be easier. Okay, so this is a graph, okay, for the distance of the market for both a call spread, which are is in green, and the bull spread, which is in red. Okay, now you can see here with the 5 wide on a call spread, you're less than 1% away from the market. With the bull spread, you're 1.2%. Okay. Now move to a 10 wide, and you can see here that the width, going from 5 to 10, dramatically different. Especially on the bull side, on the bull spread, where you go from 1.2 to 1.7%. Okay, and then if you go to 15, you get diminishing returns basically. Now you only get 2% more on the bull spread in order to take that further away from the market. Now when you go to 20, 25, 30, it really diminishes it, and it just doesn't make sense to put on that trade because you're just inching to the to get closer to the or further away from the market, and it's not doing a lot of good actually. Okay, all right, so this one here is in a 22 VIX. Okay, it's a lower volatility environment. Now let's go to a 27 VIX, right? So just 5 more points, and you can see here how much greater it is going from 22 to 27. All right. So, and you'll see it once you start placing these trades in a lower environment, lower volatility environment. You'll see that the positioning of these really make a difference with the volatility. Okay. All right. So let's go to a one day DTE instead of 0 DTE, and you can see here that the width or the distance from the market is actually lower on a 1 DTE than it is on a 0 DTE. That's pretty amazing, because you get 24 hours of decay, but it's actually less if you trade 1 DTE rather than 0 DTE. So that's really the power of 0 DTE. Okay, so it's almost not really worth doing during 1 DTE with SPX. And then again, I'm going to show you the difference between the SPX trade and the options on futures trades and how much better that is. Okay, All right, so let's go into the specifics on some of these trades. So this one here is 0 DTE. It's a bull spread, and here is when it gets, when it's threatened. And so you can see here that the market is at 35.80 here. All right, we placed a 35.75, 35.65 put spread, and it's 5 points from being breached. Okay, so the premium has risen to $2.45, and it's actually passed already the 3x mark to close the trade. All right, so now you can initiate the roll using the same strikes, and it gives you $1.75 credit. So now you're rolling that to the next day, okay, and you're collecting $1.75. Well, the trade is still basically threatened at that point, but you're collecting $1.75, all right, on it. So this is what you would do if you just use the same strikes, okay? So now let's go into another scenario here. Let's use a bear spread, okay? Kind of the same situation, but it's a bear spread. And you can see here that instead of $1.75, you're collecting $1.15. So right then and there, you can see that it's not as good as a bull spread, okay? So let's go into a bull spread again, and in this one, we're actually going to change the strikes and move it out one day. So we're moving it out one day, and you can see here, we can still collect a 35-cent credit and still get 25 points of distance for this trade. All right, and it's just a way to roll it and get some more distance, and and maybe you don't have to roll it again, but generally speaking, you usually do. Okay, and when you roll that trade, and you want to roll it again, if you're going to roll it again, you're going to roll it so that you're rolling it out of the money, okay, to get further distance. All right, that's just another scenario. Okay, bear spread again. Now, at this point, we are, widening it again, basically roll down. We're not widening it. We're just changing the strikes on this one. But on this one, in order to get the 30-cent credit, it only went 15 points, basically, okay? It's not rolled 25. I'm sorry, it's 15. So you get 15 points away from that position, right? So in this case here, we're doing a bull spread. Now we're rolling down and we're widening the trade, all right? So we widen the trade to, down to from 35.75 down to 35.30, all right? So that is a, it's quite a distance to get, to get a distance from the market, and you still collect a 15-cent credit. So if you're going to, if you plan to roll the trade, the best way to do it to get more distance is to widen it by 1. And now by adding the additional 5 points, you're going to add an additional $500 per contract of margin. Okay, that's what it's going to require you to do in order to get that additional margin. Okay, so just keep that in mind. And so here you have $1,000. If you roll it, you're gonna have a margin of $1,500 in order to manage that trade. Okay, so here we were able to roll it 45 points down with a 15 credit on it. Okay, now a bear spread widened for the next day. Okay, here we went down to 35-cent credit, but we were only able to roll it for 25 points. So again, you want to keep that in mind when you're thinking about rolling a trade, and you know what you're going to be getting into, so that you know how to position it. All right. Okay. So here we have a bull spread, same strikes. Now we go out 2 days, all right? Now here, we use the same strikes, and instead of the 175 that we had, it gives you 40 cent more credit here in order to roll it out 2 days. Okay, so that additional credit compensates for the 2 days out. Right, bull spread rolled down and widened 2 days. Here you get 35 cents, and it gives you 60 points for a 35 cent credit. All right. Okay, and this is going out 2 days in this case. All right, hang in there with me. Now we roll down and widen 2 days for a bull spread. We get a 15 cent credit. And this is a 2-day roll, and we end up with 100 points away with widening it by 5 points. All right. So that way, if you want to roll it instead of 1 day to 2 days, you get much more return for that, for widening it and then getting a lot more distance from the market. Okay, so that's probably that's probably a really good scenario for you to do, because if you roll it 2 days, and it gets threatened on the second day, you can still roll it again and get greater distance, instead of waiting the 2 days. All right, so you have some options there. Okay, bull spread, same strikes, next day, 0 DTE. And in this case here, this one was rolled and it was in the money, okay, that it, when it was rolled. And you can see here, even on a bull spread, you're not going to get, if you want to roll this trade, you're not going to get a credit on it. You're going to pay a debit on it. And that's why, I always say, when you roll these, you want to roll them when you're out of the money. Okay, once you get in the money, then it gets very costly to manage. Okay, all right. So bull spread, same strikes, next day. We got here a rolling it down in the money compared to out of the money. You can see here that both, the credit on there went up to $6.10, and then in order to roll it down, you're going to have to pay $3.30. Basically it'll cost you for that. So I want to make sure you guys, really understand, and if you're going to roll these trades, don't do it when it's in the money. All right, do it well before. Okay, so you really want to be cognizant of that. Okay, here this is a in the money bull spread, rolled down and widened. All right, here we're able to salvage it, for basically zero, but you only got 15 points downside protection here on this one. All right, so in the money you got something, but it's still, you're not gonna have to pay for it, but you're not getting a lot of distance on this. Okay, in this case here, let's look at a 1 week out on this. Okay, so this one here, we're rolling, lowered the strikes and pushed it out 1 week, and here you do get additional distance for this. Basically, you're going from 36.90 to 36.20 on this roll. Okay, by pushing it out 1 week out. Okay, all right. Roll down and widened 1 week for this one. This one's out of the money, and widening the trade for 1 week. We get basically, I think it's 125 points. Is it 30? Yeah, we get more than 100 points on this if we push it out 1 week. Okay, so I'm going to give you some examples here on some trades that I did, and just basically show you the real scenario of what can happen when you're rolling a trade. And this is probably the worst case scenario that you can go through, and I wanted to share that with you so that you know what you're getting into. Okay, so here I put on a trade, okay, and this is when I was trading 15 wide positions, and I collected 70 cents for this trade, right? The market went down. Let me get that out of the way here. Okay, the market went down, and basically going against me. Okay, and so what I did was I rolled a trade from 41.25, 41.10 to 4100, 40.85, and basically collected $1 for that. Okay. Right. And then on the next day, the position basically was did I close it? Let me see. Did I close that? I think I did close that position. Yeah. So I closed that position for $1.70 on the following day. Okay. Okay. So that's one scenario of rolling a trade and basically collecting more than you plan to by rolling it. Okay. So that's the good side. Okay. So here, this was an actual trade that I did on May 18th. Okay. And I want to show you how this could possibly go bad on you. All right. So this was a trade that I rolled a couple of times. Started with 518, and you can go back and look at the market and see where that was. So I put on a trade. I put on a put spread, and it was 39.90, 39.50, 39.35 put spread for 60 cents. Okay. And then I put on a call spread, 41.25, 41.40 for 50 cents, right? And then added to the put spread another 60 cents, basically same strikes. And then closed the call spread for 15 cents. And you can see here that the market continued moving down, right? Didn't stop. So what I did was I rolled the trade now from 39.50, 39.35 to 39.45, 39.20. Okay, so I widened the spread and I did collect 75 cents, right? The next day, I had to roll the trade again, and this time went from 39.45, 39.20 to 39.30, 39.90. So I widened the spread quite a bit and got a 5 cent debit on there. Okay, so basically break even. Then on the 20th, I bought to close the 39.30, 39.90 for 30 cents. Okay, and was able to close that position. And what I wanted to share here with you was the cost of this, okay, for me to do this. So it's really nice to be able to, roll a trade, roll it again, and finally get a gain on it. But you have to understand the pain in what it's going to cost you in terms of margin, right? So the first one I did, let me go back here. The first one I did here, right? I had $1,500, and it was a 2 contract position. So, I had $3,000 in order to manage that trade. Okay. The second, or basically the first roll I did after we put on the position, it went from 15 wide to 25 wide. So I widened it by 10 points, okay? So instead of a margin of 3,000, it turned out with two positions, it turned out to be 5,000, all right? And again, yeah, I'm still making money on the position, with the credits, okay? On the second roll, I went from 25 wide to 40 wide, right? Now I'm in a position that I'm having to use $8,000 of margin in order to keep this position solvent, okay? And then finally, I was able to close it out for $2.60 minus the 30 cents, that I paid for it. So I basically collected $2.30. Now, what could have been wrong? What could have gone wrong? The market could have continued to go down, right? And then I would have had a larger max loss, and I would have had to add additional margin in order to not have to pay for those rolls, right? So I've done it both ways. I've used debits, so that I don't use that much margin, and collected it, and it's worked out. But I just want to be clear and make sure that you understand what you're getting into if you go off and manage these roles, and the amount of capital that you need to use in order to do this correctly, right? If you have a lot of money in your account, it's great. You can do this and use other positions to collect additional credit, and we do that in the group as well. But again, I just want to make sure that you understand the details of doing this and collecting credit. All right. Okay, so that's the those are the 0 DTE trades with SPX. Now I want to share with you ES options on futures trades. Okay, so I'm bringing this in because I know that I trade with a lot of traders that don't have a $25,000 account, and they use this instead of SPX. And I'm going to show you actually the benefits of this scenario. Okay. All right. So entry on these, enter spreads within the first hour of the overnight session. So I mostly use this for 1 DTE. Okay. And it's worked out really, really well for me, actually. And the reason is that, and I'm going to share with you the reason this really, really works. Okay. So I enter usually around the first hour of the overnight session, or around 2 o'clock in the afternoon. Okay. When I enter these trades. After profits taken, I confirm tops and bottoms, and re-enter a trade if I need to, if I need to roll it. So these trades you don't roll. You basically close them, and then you place them again. Okay, so you actually are taking a loss when the trade gets threatened. All right. But the premium I use is between 115 and 140. Sometimes I use less than that. Depending on what the market conditions are, and then take profit, I use 10 cents or 5 cents for each spread to take it off. Now remember, or expiration, I typically don't let this expire just because there's opportunity cost to put on additional trades, especially if they expire or they get down to 10 cents in the middle of the day. All right, trade is threatened. You can use a 2x or 3x short strike just as a stop loss, and I do this on this. In fact, I did it today, and then put on another trade that's further away from the market to keep it going. Okay, rolling the trade using a condor within 20 points of the breach. Okay, so you can actually roll this trade. You can actually roll it by closing the position and adding it so that you get greater distance to the market. Okay, but you can't really roll these trades. All right. Okay, close a threatened trade and open a new trade with a net credit. Sometimes you don't get the net credit, but you mitigate the losses on that trade. Right, here's our performance for 0 DTE. for SPX, right? And in February, we're actually doing really well. In August and September, I wanted to go with 5 wide, just to go through that experience, and with the new ways that I was rolling these trades and using 5 wide, or using 5 contracts. You can see here in August and September, it did really well. Okay, but normally, and I had a bad month in November on this. But this is the actual performance that I have, typically using 1 contract. All right. Okay. And February has been pretty profitable as well. Okay. I want to compare the SPX to ES in this, and as you know, and it might allow you to instead of trading SPX, trade ES on this. Okay. So number 1, overnight risk. So SPX, there's overnight risk because you cannot close a trade unless you have a different broker. But typically you can't close the trades overnight, and so there's no overnight risk for ES because you can close and open trades overnight with ES. The multiplier is 100. So you see with SPX, there's 100. Contracts per 100 shares per contract for SPX, and for ES there's 50 shares per contract. So it's half the amount. Okay, so you have to get that through your head, and so you're risking less with 1 contract for ES. There is greater margin requirements, and ES has less margin requirement, and that doesn't have to do with 50. It's just the cost of the trade and how much the requirement is that the broker provides that makes the difference. All right. So there's less margin that you have to use for ES. Ability to roll the trade into later expirations, that you can do that for SPX. You cannot do that for ES. Cash settled for SPX, futures contract settled for ES. And so if you have a position that's completely in the money, okay, past the long strike, it'll settle as a loss. All right, basically a cash loss. if it's in between the spread, they'll assign you a futures contract, okay, to get that settled. Okay, and that's just how it works. All right, commissions, fees are less expensive with SPX, and the fees are more expensive with ES. However, because of the margin requirement, it's actually less costly to trade ES than SPX. All right, so here is an example of comparing a SPX to ES, and the reason that the 3840, 3830 is different from 3860, 3850 is because of the futures contract. Okay, so to make it like apples to apples, you have to use the market numbers between ES and SPX. Okay, so here you see it's 1 contract. Remember, it's and for SPX it's 100, and for ES it's 110. So you got to divide that by 2, right? So you're actually trading not 110, but you're trading actually 55 cents on this position. Okay, so the requirement for buying power is 921 here, and this one is 506. Now I'm going to move this to make it more compatible. Okay, and the best way to do it is to use a you can see here the max gain here, 77 and 51. Okay. Okay, we talked about that. All right. So now let's look at darn me, sorry, in the middle. Okay. So now let's look at the apples to apples basically on this trade. So instead of using one contract, or not one contract, but instead of using 10 wide, I use 15 wide. Okay. Now that gives you a apples to apples comparison, right? Because 160 divided by 2 is 80. So you're actually collecting $80 on this position because it's widened and I'm using one contract. Okay. So SPX 100 multiplier, ES 50 multiplier. Okay. And that's why the numbers are different here. All right. So now what you're getting is basically the same credit, right? For using a 3 wide here instead of a 2 wide, or 10 wide, 15 wide instead of a 10 wide, all right? So you're basically using the same amount of margin or less margin to get the same results. So here, 921 margin requirement, and for the same amount of money, you get 762. So that's why I'm saying, you know, the margin, you're actually utilizing less margin, so you can put on bigger trades compared to SPX, and that's where the commissions come into account. Okay, so it's actually less costly to trade SPX or ES, and it has a lot of other benefits as well, including no PDT. All right. Okay. So hopefully this was of value to you, and I want to share with you our bonus here in what I was talking about. Okay. And again, I'm going to get to your questions, and just wanted to share with you. Would you like to follow our trades while you learn using our short-term strategies I've outlined so that you can be a consistently profitable trader? And the answer for that would be yes, right? Of course it would be yes. All right, so just remember that you were interested in learning new strategies, you desire to see your account grow month after month and find the right strategy that provides consistent trading results. Well, this is it, guys, all right? I really believe when I put this together, I would put in a plan that I would allow people to learn these strategies while you earn, okay? And that's really, really the goal here, all right? And so the question is, do you want to break these barriers that you've had, right? Because I've been through them too, and you know, it's really important that you make that decision, okay? Will you keep doing what you're doing and hope that one day something will stick? Or are you finally going to take the steps that will get you to a place that, you know, that really, really works, all right? And it's not only, you know, the strategies that we put together and everything else, you know, but you really have to have a no-quit attitude, commitment to you know, really trying to make this thing through, discipline and having an edge and multiple edges that we give you as well, all right? And that really gets you to a place of success, and that's where you want to be, right, as a trader. And so, you know, it's not an easy thing. And so what we do is we have a trade alert service, okay? And the trade alert service is integrated with my trades in my account, all right? And we've done this so that there's no errors or least amount of errors, and the one-way communication is very, very clear on what you're going to, you know, what you're going to trade with, right? And so it's really fast. We use Telegram, and it's a great tool that we use, all right? I do have it integrated with my Thinkorswim account. So the 0 DTE, 7 DTE, monthly trades, options on futures trades are integrated, and we automatically provide performance data in there as well, all right, as we go. And so we have two ways of communicating. One way is two-way communication, all right, where this is where you ask questions, you learn, and you get answers that you want to that you're asking for. Okay. The other part is one-way communication, and these are the trade alerts. The trade alerts come in. It's it's exactly what it is. You copy that trade, and you can even copy it with Thinkorswim, and then and that's how you take that trade. So so that's how it works for the most part. Some of those trades are other subscriber trades. They're not integrated, but they're very, very clear. These guys are professionals that we work with, and it really makes for a great experience in and out of the service. All right. So we have a lot of trader success stories. You can read these as you go along. Marianne loves 7DTE. Bruce was with us. Did great with the program. With 0DTE and 7DTE monthlies, etc. Glenn was with us for a while. He went from 4 months currently up to 22 grand, and then Dale, he loves 0DTE and 7DTE. He went from 3,000 to 31,000, in a few months, and really loves the program. And so the other part of this is that it's my guarantee. All right. So if you subscribe with us and you lose money by following my trades, I'll refund you the subscription by 125%. Okay. So yes, we take losses, but over a month, right, that you're in it, that's my guarantee to you. So if you lose money during that month taking my trades, then then I can refund you that amount. But it's never happened before, so I've never had to go good on that. Thank God, right? Never had to go good on that promise, but it's working. It just really, really works. Okay, so here's the offer. We're actually not live right now. We're not live. We're live, but I'm saying the offer is for a wait list. Okay, and so we do the wait list because because we like to answer the questions. People get in, they like to ask questions and answer, and get the answers to their questions. And so we open it for a short period of time, and then we close it. Okay, and we close it because we open it so that we get all the questions answered at one time. We close it, we get all those answered, and then basically we focus on our traders. Okay, and that's the reason why we have the wait list. So at this moment in time, we don't, we're in a wait list period, but it's it's only every 3 months. We open it for a couple weeks, and then you get in, right? And so if you join our wait list, you will get $20 off for life. All right, and that's a promise that we keep. So the current value, the current amount that it costs you is $59.99 and $129. If you go in the wait list, it's $39, $79, and $109, and this is forever. All right, as long as you're with us. And so the 39 plan does monthly trades. These are AM expiration trades, SPX, and you also get the subscriber trades and the education that goes with it, and I'll share that with you in a second. The 79 plan does the monthlies, and then we do 7DTE and 0DTE in those, and then we have the 109 plan that goes to the futures. It's for futures trades, and we have a live room that's open all day long. You learn Elliott wave theory, ABCD patterns, and then you get additional trades in there as well, right? That are live. So it's really a great value to get in here and try us out. Okay, so if this is for you, you want to learn a step-by-step process to gain income in a market that goes up and down. You want to finally break the series of losses and account drains, and you want to earn consistent income that sets you apart from other traders. Hey, this is it. It's it. And again, you're going to learn while you earn, and it's just a great environment to learn with. Okay, again, so what do you get? $20 off when you subscribe, by joining our wait list, a professional traders group and subscriber trade chat group. You also get training and education. You'll get that, when you join. You'll get that with our education portal. You'll get an email giving you instructions on how to access that. You get automated signals in seconds of my trade. So these we've created this and put this together and integrated it so that this thing really works and it's seamless. Okay. Also, we give you trade entry, fill price, price target after fill, how to roll, the positions to roll on the trade, and then my guarantee that you will make money. All right. And so that's really it. Hopefully you'll be able to join the wait list and get in there, and you won't regret it. Okay. So let me get to the questions here real quick. So why is the bid and ask price wide? So wide on the trade. The SPX is an index, and so it goes in $5 increments. All right. You can't see the bid and ask, and that's just the way that it is. All right. And so that's why it's wide. Where can I get a copy of the trade plan? Yeah, we have a link for that, and we'll get that to you as well. I think we send it in the replay. So you should be able to get that. What exactly do you mean spread width? Okay, so when I say spread width, that means that that the vertical, right? You have let's say a 30-40 and then a 30-50. That the width is the difference between the two. So that's a 10 wide. So if it was 30 and 45, that would be a 15 vertical width. Okay, so that's what that means. All right. When you roll, do you limit the order? Or market order? No, it's a limit order that we do. And sometimes the market moves fast, right? So sometimes, you have to get in there and place it. If it doesn't work, lower it or higher, raise it depending on the direction of the market, and then you get executed. So it's not a perfect science, but you'll get within the right range. When you select the strike price and associated 10-point spread, what ID rule delta are you electing? Okay, so I don't use, after we roll, we don't use the delta. We use basically the credit the credit, or sometimes the distance that we want to have for that particular placement. So that's not a hard and set rule on that one. Okay. How do you select the strike price? Do you use delta? Okay, so when we select the strike price, I use a 45 to 90 strike price. Usually it's 50 to 60, and that's really where I get the strikes. Okay, the strikes are equivalent to about a 6 delta. All right, when you use that 10 wide, 50, 60 premium to that, and so you can check it, and it'll that's what it is. So based on multiple roll trades, you needed 8K in margin in order to make $230. That's exactly right, just for that particular trade. And it was kind of a worst case scenario on that. How do you roll ES options if rolling is not permitted on futures? You close the trade and then you reinitiate the position. Okay. To a new position, and that's really the way that you do it for ES. For what service do you use to send trade alerts? Okay, so that's an integration with Thinkorswim and Telegram that we've developed. We have a developer that developed that that allowed us to transmit to integrate that so that the trade alerts would come through, right? So it's a it's a development process that we use to create that, and we're constantly refining that as well. Do you have a spreadsheet of all trades? Yes, actually, in all the trade alert channels, we have the performance of each and every trade that we have in there. Okay. Is a recording provided? Yes, you will get a replay of the recording. Hi Al, thanks for the education. I understand that 0 DTE, live trades, and all the other trades are the same. 7 DTE and monthly are your trades, and other people are publishing as well. Yes, that's correct. So I do manage 0 DTE, 7 DTE, monthlies, and options on futures. Those are all integrated trades that we have. How do you decide on the strike price? As I mentioned, the strike price I use, between 50 and 60 for 0 DTE on that. How do you, what trading platform brokerage do you use? I use TD Ameritrade, Thinkorswim. How do you select the strike prices in the morning? Okay, I think I answered that question already. Do you teach what you look for so people can always have to rely on alerts? No. So when you get in, again, you're earning while you're learning. Okay, so you can get in there and ask all the questions you want from me and other traders. You can send emails to me. I respond. Even if they're complex questions. Okay. This is just not a trade alert service. It's a learning atmosphere that you guys can learn and eventually do this on your own. Okay. And that's really the goal of this, right? Okay. So, got that. How do you select the strike prices? Okay, I mentioned that already. Okay, do you teach what you look for so people, okay, talked about that. So when you add commissions, seems very minimal wins compared to directional trades. I guess the advantage there is a win rate. Yes. So our win rate is in the 80 percentile range. We do base hits, and they're just consistent, and that's what we do. Thank you all for the insight and engaging session. Hey, thank you. Appreciate it. Okay. How do you select the? Okay, we did that. So you only spreads approval, not uncovered. Oh, covered calls. Or uncovered. Okay, naked. Yeah. So I think it's a level 3. You need to talk to your broker, but I think it's a level 3 level for options. Okay. And okay, I think we got this. Can you send the link? Yeah, you'll get the link for the wait list after the session. All right. Okay. I think I answered most of your questions. If not, you can always send me an email at al@simpleoptionstrategies.com, and I will answer all your questions. Hopefully this was of value to you, and I will see you after you've gotten into the wait list and joined us. All right. So hang in there. It's less than 3 months. You'll get in, and it's going to be a great experience for you. All right. Appreciate your time. Hopefully this was of value to you, and I'll see you on the other side. Thanks.